Welcome back to Finance Basics, where we break down complex finance topics into everyday examples. Today, we're diving into something called a naked option. Now, if that sounds risky, well, it is. But let's keep it simple with two examples, one about renting a car and the other about stocks. So here's the setup. Imagine you have a friend who might need a car for a weekend trip. He's not sure yet, but wants the option to rent a car from you if he decides to go. You promise him he can rent your car for $100, and for that promise, he pays you a $10 fee up front. Here's the catch. You don't actually own a car. You're betting that he won't even end up needing it, so you get to keep his $10 with no hassle. If he decides he doesn't need the car, great. You made $10 for basically doing nothing. But now, here's where it gets risky. Let's say your friend does decide to go on the trip. He's going to come to you expecting that car for $100. Since you don't have a car, you'll have to rent one yourself. And let's say it costs you $150 to rent a car that weekend because of high demand. You've got to stick to the promise, so you rent the car at $150 and hand it over to him for $100, taking a $50 loss. You see how risky that is? You made a promise you couldn't back up unless everything went perfectly. Now let's move this idea to the stock market. Picture stock XYZ, which is currently trading at $50. You decide it won't go higher than $55 in the next month. So you sell a call up promising that they can buy XYZ stock from you at $55 anytime within the next month. For this, they pay you a $5 fee, and just like before, you don't actually own any shares of XYZ. If XYZ stock stays below $55, they won't need the option because they can just buy the stock cheaper on the open market. So you keep that $5 fee as pure profit. But if XYZ suddenly shoots up to $70, things get rough. The buyer will use their option to buy it from you at $55, which means you'll have to go out and buy XYZ at the current 70 market price just to sell it to them for $55. That's a $15 loss per share. In both examples, the naked option means you're taking on the risk of making a promise without actually owning what you're promising. You keep a small fee if everything goes your way, but if things don't, you could face unlimited losses. That's why it's called naked, because without owning the underlying asset, you're exposed to big risks. So while naked options can make money if you're right, they're risky because things don't always go as planned. And that's it. Hopefully, that gives you a clear idea of why this strategy is high risk and why traders approach it carefully. Thanks for tuning in, and as always, keep it simple and keep it smart.